Pepsi just reported earnings and the stock fell to about $137, near the bottom of its 52-week range. Even Wall Street is cautious now. 20 analysts cover the stock, and the consensus rating is a hold. So after this drop, the real question is simple. Is Pepsi a bargain or a warning sign? We ran it through our fair value model, and the answer is more precise than cheap or expensive. Well, let's start with what Pepsi actually reported. Core earnings came in at $2.20 per share, 1 cent below what analysts expected. But revenue was a beat at $24.2 billion, ahead of the roughly $24 billion the street wanted. So if revenue beat, why did the stock fall? Because the market did not sell the top line. It sold the profit line. Core operating margin slipped to 16.8%, down 40 basis points from a year ago. The problem was never the revenue, the problem was the quality of those earnings. There are 3 reasons behind the drop. First, that 1 cent miss broke a streak of beats the market had counted on. Small on paper, but it changed the story. Second, and this one matters most, in North America, Pepsi's food revenue fell 2%, with effective net pricing of minus 2%. In plain English, Pepsi is cutting prices to hold its spot on the shelf. That protects volume, but it squeezes margins. Third, management guided full-year earnings toward the lower end of its range, pointing to higher costs in the back half of the year. And in the days after, several firms trimmed their price targets. Now the other side. Pepsi's international business grew high single digits, and it is on track to pass $40 billion in revenue this year. So this sell-off is a verdict on the American consumer, not the whole company. So after the drop, is Pepsi finally cheap? On forward earnings, Pepsi trades at about 15.9 times next year's expected profit. Look at the peers. Coca-Cola trades near 25 times, Mondelez 19, Keurig Dr. Pepper 13.5, General Mills 12.5. Pepsi sits in the cheaper half of its own sector. And against its own past, the discount is real. Pepsi's 5-year average multiple is closer to 20 times, so today is a clear step down. The dividend says the same thing. The forward yield is about 4.3%, near its highest level in a decade. But here is the catch. A low multiple is only a bargain if the earnings hold up. And with margins shrinking, that is the one thing the market doubts. So being cheaper than usual does not prove Pepsi is actually cheap. For that, we need the real fair value. Here's how the model works. It blends 3 methods: 40% forward earnings, 30% enterprise value to EBITDA, and 30% dividend yield. Then it runs the same rules through 3 scenarios: a bear case, a base case, and a bull case. In the bear case, where the margin pressure sticks, fair value is about $131. In the base case, it lands at $151.15. In the bull case, if North America stabilizes, it climbs to about $174. Against a market price near $137, the base case points to roughly 10% of upside. So the verdict is fairly valued, leaning cheap. Pepsi is not a screaming bargain, but it is not a trap either. So what do you do with that? It depends on your risk. The base case upside of 10% is below a 15% margin of safety. So a cautious investor waits, either for a bigger discount or for proof that North America margins have stopped falling. A more aggressive investor can take the other side and simply get paid to wait. The dividend hands them 4.3% a year, while the international business keeps growing. The key risk is simple. If those American price cuts become permanent, the bear case becomes the base case. If this in-depth analysis helped you, subscribe to our channel and drop a comment with the next stock you want me to run through the model, and give a thumbs up to support us.